In today's video, I'm going to teach you whether it makes more sense to invest a lump sum all at once, or whether you should spread that out over time using a dollar cost average strategy. Hey everybody, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. If you've come into a large sum of money, you've likely asked yourself, what makes more sense? Should I take this sum of money and just put it in the market and invest it? Or is it safer and maybe more beneficial to spread that out over time, instead investing little bits over a period of months, quarters, years, whatever it might be? Now, this could be money from an inheritance. This could be money from the sale of a rental property. This could be money from the sale of business. It could be a large bonus. It could be anything. Regardless what it is though, you probably have that question. What's the most efficient way to take this sum of money and get it invested into the market? That's what we're going to explore today. To do so, I want to start with two quick examples. Here's the first example. Let's assume I give you $10 and I say you have to invest this. You can't spend it, you can't do anything else with it, you have to invest it. Are you going to invest that all at once, or are you going to spread that out over time? Okay, remember that answer for a second. Now let's assume I give you $10 million and I also say you have to invest this money. Are you going to invest it all at once, or are you going to spread that money out over time? Comment below, I'd love to know what your thoughts are, but while you're doing that, my guess is many of you had two different answers depending upon the amount of money you received. With the $10, it's likely you said, I'm just going to invest this. If this goes down in value, maybe $10 turns to $7, so what? It's not that big of a deal in the grand scheme of things. Whereas my guess is most of you with the $10 million, it's a lot harder to say, I would just invest that. Because if you get a 30% decline, which is the same decline that took the $10 to $7, well, in this example, that takes a $10 million to $7 million. That feels a lot more difficult. That's a kick to the gut if $10 million immediately drops to $7 million because of a poor market environment. So as we're looking at this, that's the first example I like to give. And the reason I give it is because so many of us have different examples depending on the dollar amount. Now, from a return perspective or an expected return perspective, whether you have $10 or $10 million, it shouldn't make a difference. The dollar value of the return will certainly be different, but the percentage gain or decline would be the exact same. What the difference is our emotional reaction to that. The way that we would react if $10 turns to $7 is very different than the way we would react if $10 million turns to $7 million. So I start with that because what that highlights is that so much of this decision is an emotional one. Now that's not bad. It's not bad for there to be an element of emotion to this decision. There's an element of emotion to all financial decisions we make. Here's what is bad though, is when we try to disguise this, or we try to delude ourselves into saying this is a logic-driven decision, when in fact it's an emotional decision. So it is not bad to recognize that there's an emotional aspect to this decision, but you must recognize that. The ancient Greeks said, know thyself, and with investing, that is so true. We need to know thyself and understand when a decision we're making is based upon logic and reason versus when a decision we're making is based on emotion and concern for what might happen. So the first thing to note is that a dollar cost average decision is primarily done for emotional reasons, less though than logical reasons for most people. That's the first thing that we want to start with. The second example is this. I give you $1 million and I say you have to invest this and you are tasked with increasing the value of this as much as possible by the end of a 100-year time period. So a very long time period, an extreme amount of time here, but I give you two options for doing so. I say you can either invest it all today and let it ride for the next 100 years, or you can invest $10,000 per year every single year for the next 100 years, which would total investing $1 million over that time period. Which option would you select here? Now, as you're thinking about it, most of you, my guess, is you would choose that first option. You would say, well, if I had 100 years to do this, I'm just going to put that money to work. If I do $10,000 per year for the next 100 years, there's just too much time where a big chunk of that investment is just sitting in cash, missing out on market returns. So when we use this example to the extreme, we can start to see how dollar cost averaging, if we wait too long, can actually hurt us. In fact, if we want to run those numbers, here's exactly what that looks like. You can see from this chart here, what this is showing is in this column here, column B, this is showing what if you took $10,000 every single year for 100 years, which is $1 million that adds up to, and you gradually put that into the market and you earn a 7% return on the investments that you are making. Then in this other column, in column E here, this says, what if instead of waiting, you took that full $1 million and you said, I'm just gonna put this in the market, I'm also gonna earn 7%, and I'm gonna have this money growing for me for the next 100 years. Here's what that looks like. Well, you can see here in C, account value, this is showing what if you take this investment and here's the growth on that after 1 year, here's the growth on that after 2 years, 3 years, 4 years. So 10,000 coming in each year, growing at 7%. Versus this column is what if you just invested the lump sum? Well, it doesn't take long to see that if we fast forward all the way down, investing the lump sum would have ended up with $867 million at the end of that 100-year time period. 1 million turns to 867 million, which obviously is a long time period and a huge starting amount, but that's a substantial amount of growth. If you had taken a dollar cost average strategy towards that, $10,000 per year for 100 years, you would have had about $124 million. Still a substantial amount, but the other strategy, the lump sum, would have given you 7 times more wealth by the end of this had you invested all the money all at once. Now that's an extreme example. None of us likely have $1 million that was given to us with the task of growing that over the next 100 years. It's a very long time period and it's a pretty significant amount of money to be given to us just to invest. So why do I even bring it up? Well, I bring it up for this reason. When we take things to the extreme, we can start to understand some of the flaws in what that looks like. I've given this example before, but I'm going to give another example and tie this into how it relates. I'm going to give you 4 investments and you get to choose one of them. You can have whatever one you want, and by the way, this is a very real investment that you all have access to. Investment number 1, it goes up in value 52% of the time. Investment number 2, it goes up in value 67% of the time. Investment number 3 goes up in value 75% of the time. And investment number 4, it goes up in value 100% of the time. Now, it's not a trick question. Think about it. Which of those 4 investments would you choose? My guess is you probably chose investment number 4, the one that goes up in value 100% of the time. Now, the thing is, all of those investments are actually the same thing. They're all the return on the S&P 500. The difference is the time frame that we're looking at. So investment number 1 that goes up in value 52% of the time, that's daily returns on the S&P 500. So 52% of the time you get a positive outcome, which means 48% of the time you get a negative outcome. Not too different than a coin flip. The next investment, number 2, that's all S&P 500 rolling monthly returns. So 2 out of 3 months, the S&P 500 is up. 1 out of 3 months, it has a negative return. The third investment is S&P 500 1-year rolling returns. So about 3 and 4 years, it's a positive outcome. 1 in 4 years, it's a negative outcome. And finally, investment number 4 is all rolling 20-year time periods within the S&P 500. There's never been a rolling 20-year time period or any 20-year time period where the S&P 500 hasn't just made money, but a substantial amount of it. So I bring that up because as we're dollar cost averaging in, we have to understand the data around it. So let's look at an example using this data. If I have a chunk of money and I'm going to invest half today and half tomorrow, well, this data tells me that tomorrow I have a 52% chance of having to invest into a higher market, meaning the dollar cost average strategy would have worked backwards. It would have backfired on me. That's because 52% of all rolling daily returns are positive. So if I do half today and half tomorrow, I'm slightly less likely to make money doing it that way than if I just put it all in at once. Not too big of a difference, but that's one day. Now let's say I have a chunk of money. I'm going to say I'm going to do half today and half in 1 month. Well, now I have a 67% chance of having that money or investing into a higher market a month from today, which is the exact opposite of what I want to do. I have a 33% chance of that actually working out for me because I know that 33% of the time the market is negative over a 1 month time period. Now, if I extend that to a year, only 1 out of 4 years is this actually going to work out for me if I'm doing half my money today and half my money in a year, because 3 out of 4 years the market's positive. And so what you can start to see is when you're dollar cost averaging in, you're working against the odds. You're working against the fact that there's a positive expected return in the market every single day, every single month, every single year, every single 5, 10, 20-year period. And the extent to which that return is going to be positive increases the longer we go. So we just have to recognize that when we're dollar cost averaging, that's what we're working against. It's not to say that it can't work, but the odds are against you and it's unpredictable when the market's going to be up or when it's going to be down next. So as we're looking at the both of them, the benefits of investing a lump sum is you get exposure to the market right away. Those dollars are in the market, and yes, there's going to be some ups and downs, but again, on average, the longer we stay invested, the higher and higher and higher your probability of a positive outcome becomes. And not just the higher probability of a positive outcome, but the magnitude of that positive outcome continues to increase as well. So that's the benefit of putting your lump sum to work right away, is you're starting to capture those market returns immediately. You're not waiting at all to start dripping your money in at a later time. Now, if you dollar cost average, the benefit is more of an emotional one. Now, there is a real tangible benefit if you dollar cost average into a falling market. And now, of course, this depends upon whether you're doing this weekly or monthly or quarterly or annually. There's a whole bunch of ways to dollar cost average. But if you knew for certain the market was going to fall over the next year, yes, it makes sense to dollar cost average in. The probabilities are just against you. And this does not change whether we're in a down market like we are so far in 2022, or we're in a rising market. In fact, it might actually skew the odds more in your favor to invest a lump sum when the markets are down, because the forward-looking return is going to be higher when the market is down. However, the benefit of the dollar cost averaging approach is it emotionally feels better. A lot of people, when the markets are down or when things are happening, it's just too scary or too uncertain to put a huge amount of cash to work. That's perfectly fine. As I mentioned, it's not bad to have the emotional reaction. That is, though, why it's important to know thyself, as I mentioned before. If you know yourself and say, I just couldn't put a big sum of money into the market because I know that anything could happen, well, dollar cost averaging, even though on average it doesn't outperform a lump sum investment, it certainly outperforms keeping money in cash indefinitely and keeping money in cash forever, just waiting for things to be better, because by the way, you'll never feel like things are better. You'll always feel like there's a reason not to invest. So if dollar cost averaging helps you to get money into the market, it is far superior than a lump sum if you know that with a lump sum, you just wouldn't bring yourself to be able to do that. If you want to quantify it, Vanguard actually had a good piece of research where they showed that investing in a lump sum, on average, outperformed dollar cost averaging by about 1.5% to 2% per year. Again, that's on average. There were some times when dollar cost averaging made more sense, but on the whole, investing in a lump sum will tend to do better over time, but it comes down to that decision of what are you more comfortable with? Are you more comfortable with investing right away to get a higher expected return and accepting the uncertainty that comes with that? Or are you more comfortable with saying, I'll give up some of the return in exchange to minimize some of my risk going into the market, and that might be the better way for you. Now, you might have a lump sum to invest, and you're saying this is great. I know whether dollar cost averaging or investing in a lump sum makes more sense, but you still have questions about how does this fit into my overall retirement strategy? Well, click the video above so you can see how that lump sum might impact your overall retirement plan. Our clients at Root Financial get the most out of life with their money. Be sure to visit us at www.rootfinancialpartners.com.